Do you guys buy any non-performing loans?
We do in our Texas fund. Also, we have an association with a company that buys primarily non-performing loans from Fannie Mae and other pretty decent sized institutions, which I think that business is going to grow even more. Um, and it's really interesting because a lot of these loans are ones where you kind of wonder how did they become non-performing. You know, a house, let's say, is worth 250,000, and there's only $15,000 owed on the loan, and we're buying the loan for 10 grand. You know, I mean, you don't make a fortune off that. Rate of return, you do well, but you know what's going on? Well, sometimes it's a mom and dad died, and then so nobody knew who to pay the mortgage to, and so you know the bank looks at it and says, hey, this is a non-performing loan, get rid of it. You've heard
Interesting.
about the reverse multiplier effect,
Right.
right? I mean, it's you know banks invent money, and it does not behoove them to keep loans on the books, especially when the auditors come in, unless they're you know a number one loans.
Hmm.
I think that market's going to grow.
Um, and then it would appear is that they will. What percentage of non-performing loans end up in default?
Uh, I'd say probably 75%. Sometimes what we'll do, and again, this is um, in our Southwest Texas fund. Uh, Primarily, those there are a few loans that we buy right off the bat we know are non-performing, and they're just we know we're just going to foreclose and make a mini fortune off of it. Mini yeah, fortune, right? The association we have with another company we're helping them buy discounted loans. In that case, I'd say about 25% of the loans we try to get them reperforming because nobody wants to kick anybody out of their house, and there's usually some compelling reason that you can get them back on track. I mean, think about it for a minute. If the loan, let's say the house is worth 200,000, and the loan is 60,000, and the mortgage payment to make it simple is $600 a month, and it's not performing. Well, if you buy that loan for 30,000 and you go back to the borrower and say, well, you know what, Mr. Borrower, I understand you're having a hard time paying $600 a month. Can you afford $500 a month? You know, we'll stretch it out. I mean, a lot of times, hey, thank you very much, Mr. New Lender. You know, and you look at your rate of return of okay, I'm paying 30,000, I'm getting $500 a month for X period of time. Does it make sense? And so it's kind of nice when you can you know reperform these loans.
So when you acquire, so are you saying that out of the non-performing notes that you acquire, you take over this loan, so you're the new sheriff in town, you're the
Yeah.
new lender, and you try to, come to some kind of terms that like you just described. Are you saying 75% of those still end up foreclosing on and don't end up performing?
Yeah, I'm taking a shot in the dark on that, but I'd say that's
Okay,
pretty
all right.
close. Yeah, I think it's probably about 75% still go. Now, remember, not all the loans are, you know, 200,000 house and it's a $60,000 mortgage. You know, it might be a 200,000. Here's the interesting thing: the unpaid principal balance generally grows quite a lot because of all the legal fees and interest that gets accrued and all that. So you have a house that is worth 200,000. The unpaid principal balance might be 280,000. And the borrower is saying, you know, I can't pay. I'm not going to pay. I can't pay, and I'm not going to pay 280,000 on a $200,000 house. I'll walk away, right? But we're not paying 200,000, 280, 200 for that. You know, we might pay 100,000 for that note, right? So we have a lot of room to play with.
Yeah, you have a lot of daylight, and so
Yeah.
when they do foreclose, what do you do with the property? What do you do with the loan?
We will, a lot of times, depending upon how much we credit bid at the foreclosure, we'll do an analysis and decide, are we better off trying to rent this property? Are we better off trying to fix and flip it? Or is it the type of property that after we've assessed it, we said, you know what, let's just price our bid at the foreclosure steps so that someone will just buy it from us right there and let them deal with the headaches or the potential profit. So each situation is a little different.
And you have an associated company in Texas that does a lot of the blocking and tackling.
So that company is actually located in Scottsdale, Arizona, and they have a myriad of analysts doing that.
And so, what is your Edward? What is your role in that relationship, and what is their role in that relationship?
So we act as the lender to help them buy those notes, and then also have potential profits in the exit strategy of what happens with those notes. So they're providing the labor, and we're providing the capital.
I see. I see.
Because
Um,
we've thought about the idea of, when we had our Texas fund, our Texas partner, every loan that he found was really good. The problem was the volume. We just couldn't get enough good volume. So the president of Pacific Private Money and I talked about the idea of, well, maybe we need to kind of expand our wings a little bit and put our own team together to try and find more notes that are available, and go outside of the seller carryback ones, in Texas, very specialized. And what we found was, there's another company out there that looked pretty good, and they already have the infrastructure. Why reinvent the wheel? So if we can get associated with them, let them make some profit, we'll take a little bit less, but we'll be a little more conservative and be a lender, and then a little bit of extra profit potential on there.